Good evening, everyone. Welcome to our latest financial accounts preparation revision session. Tonight, we're going to look at task 3, the extended trial balance. A fair bit to get through. We're going to manage to do the whole task in one session. First of all, we'll look at the process, which is producing the extended trial balance, the adjustments that we make, and then finally we extend it into the different final accounts. So let's have a look at that. Involves. Task 3 is about producing, adjusting, checking, and extending the trial balance. Note that it's worth 24 marks, so it's a big task. Gives you 30 minutes to complete it. In this task, you may need to prepare an initial trial balance. So it might be you'll be given a list of balances and you've got to work out which ones are debits, which ones are credits. You may be given a list already sorted. There may be errors to correct, and you may well need to reconcile a bank. Dealing with errors, it's important that you are able to recognize when a suspense account arises. The suspense account, remember, will only arise if the original posting did not balance. So if you see 2 debits or no debits or 2 credits or just a single entry, all of these will give rise to a suspense account. If we've posted a different amount to debit as to credit. So when preparing journals for corrections, remember that your thought process is, number 1, what did they post? That's to say, where are we now? Compare that with step 2, what should have been posted? And then step 3, join the dots, as I like to put it. Compare where you are with where you need to be, and then enter the extra figures in. Remember, you can only ever add figures into ledger accounts, you can't take them out. After a preliminary trial balance has been produced, there may be further adjustments that are necessary before final accounts can be produced. So there may well be notes given as to other things that are needed. To produce an extended trial balance, we use the following steps. Complete the trial balance column with our general ledger balances. They should balance. And again, that's one thing to check, is that the totals at the bottom do agree. If not, a suspense account is needed. In the adjustment column, columns, we really perhaps should say, record adjustments that are necessary. Remember that there must always be in your adjustments a debit and a credit. So if it says an allowance for doubtful debts of £200 is needed, we've got to debit something, which is going to be the adjustment, and we've got to credit something, which is going to be the allowance. And the way that you check that you've not forgotten to do that is to total the adjustment columns. Make sure they're the same. It sounds a bit obvious when you say it like that, but I have indeed seen plenty of cases where that was overlooked. Once we've done our initial trial balance and our 2 adjustment columns, then each row will give rise to a final figure, which will be the original figure plus or minus the adjustment, and that goes either to the profit and loss columns or the statement of financial position columns. The simple way I like to remember which of these is which: statement of profit or loss, things that happen. A sale takes place, a purchase takes place, we incur or we pay an expense. These are all things that happen. You can't look at the desk in front of you and say, oh, look at my big pile of sales I've got here. You may have the record of them, but a sale is a thing that takes place, and all of the activity goes to the statement of profit or loss. The statement of financial position, these are things that exist. They have a balance remaining, whereas everything that goes to profit or loss is cleared down. So if somebody owes you £1,000 on the last day of the old financial year, they still owe you £1,000 on the first day of the new financial year. And essentially they all fall into under the headings of assets, liabilities, and capital. But there is, of course, the one exception that just spoils that rather neat analysis, the dog in the manger, and that is, of course, drawings, which, although drawings are a thing that happens rather than exists, they are an adjustment to capital. So that's why drawings go on the statement of financial position. Other than that, if it's an asset or a liability or anything to do with capital, it's statement of financial position. And if it's our trading activity, our business activity, statement of profit or loss. So once we've done that, we total the profit and loss columns. These will not and should not balance. The difference is the profit or loss for the year. If the profit has been made, you will need an extra debit to make the columns balance. This is the profit for the year. Well, let's think about why that is. We graphically represent the values in our statement of profit and loss. On the credit side, we'll mostly have sales and any other bits of income. If we've made a profit, it is essential that the total of all of those credits is greater than everything that goes on the debit side, which will be our purchases and our expenses. And the credits must outweigh the debits because sales has to be bigger than everything else. If the money coming in isn't bigger than the money going out, we've made a loss. So sure enough, that amount that we're going to add in is going to be our profit. The same logic in a different way applies to statement of financial position. What will do if I can, dear. There we go. In this case, the inevitable effect of making a profit is we have more money. Now, we might use that money to buy other assets, like we might buy machinery. We might use that money to pay off loans and reduce our liabilities. But either way, the effect of having made a profit during the past financial period is that our debits, which essentially are our assets, better write that in full, will be greater than our liabilities and our existing capital. So liabilities, liar, and our capital. And the difference between the two will be explained by the profit that we have made in our statement of profit or loss. And that's how it all rather neatly fits together. And of course, at the end of the process, what will we do? We will add that net profit into our capital. So next year, our starting capital will be that much bigger, unless we've drawn it all out, in which case it will be smaller. And the effect of drawings is to take money out of the bank and take money out of that capital. So that's the effect that drawings has, if there's drawings present. So I always like to look at why things are as they are. And already we're on to tasks, not so much theory this week, more tasks. Now, here's an example task. This is a control account task, and there is a real neat way to tackle these. The least work you can get away with is to look at each item and try and decide in isolation, is that something that affects the the payables ledger control, which we used to call the purchase ledger control, or does it affect the list of individual supplier balances? Because we have to identify which is which. Here's how I do this. So what we say is do two columns: payables control and supplier list. And we are told that at the start of this process, the balance on our payables control is 6820, and on the list of balances is 530. 561. So we're a fair way out. Now I look at each of these. Item 1, a contra entry has been included in the payables ledger, that's the supplier list, but has not been included in the nominal ledger account. So now you have to know that the payables control is in the nominal ledger, the main ledger, the general ledger. We give it a new name every 10 years, don't we? Used to be called a private ledger. So we need to know that that is in the nominal ledger. So what's missing, had not been included, is in our control account. And the effect of a contra is to reduce the balance owing because we are setting it against an item that is owed by a customer. So that is going to reduce our payables control balance by 425 and have no effect on our list of suppliers because it has been included. Purchase returns daybook has been undercast by 350. Now in our daybooks, remember the individual line items. Here's our daybook. The individual lines all go off to the individual suppliers, and it's our totals that go to the main ledger, the nominal ledger. So if the daybook is undercast, it's the totals that are wrong. Totals that are wrong, not the individual entry that's gone to the supplier account. Therefore, again, this correction is in the main ledger. Now, a return reduces the balance owing. So if we've undercast, we need to increase the amount we reduce it by. So that's another subtraction. Double negatives are quite difficult to think about. Yes, it's a reduction in a reduction, so we need to, yes. Okay, the amount we've reduced it by, we have reduced. So we reduce it by more. Item number 3. Discounts received of 342 have been posted as a credit entry on payables ledger control. So there's no mention of any error in the supplier list once again. So the correction is to payables control. But we need to think about how much this time, because discount received is a form of income. So we will be recording that as a credit, discount received. If we've recorded it as a credit in payables control, that must mean that we have also big balance in our suspense account. So to correct this error, plainly, we are going to have to go twice as far in the correct direction. So nice empty suspense account. So this time we're going to subtract 684. Number 4, a payment of 233 has been allocated to the wrong supplier within the payables ledger. Now that's not going to affect the total at all. So one's going to be up, one's going to be down. It's an error that needs sorting, but it's not going to affect the total, and it has no impact on payables control. And at this point, having run out of adjustments, what we are able to do, if we take 6820, subtract 425, subtract 350, subtract 684, that takes us to 5361, which in this example is a match. And if you do that, you can have a fairly high degree of confidence that you've picked the right items and analysed them correctly. Another example, you may well have, I've seen this with 5 or 10 items, and some of them will affect the supplier list and others will affect the control and some will affect nothing. By by reconciling the closing balances. So I think we're pretty happy that. Now, payables ledger is controls a liability. So to reduce it, we're going to debit. So we're going to item number 1, we're going to debit 425. Item number 2, we're going to debit 350, and then 684. And the last item is just no effect. And we've already identified that our corrected balance 5361. I have a favorite saying I say a lot. Often the quickest way to solve a lot of these exercises is the slow way. So yes, there's a bit more writing in your rough notes to do this reconciliation, but I honestly feel that little bit of extra time invested saves a lot of double checking and uncertainty. It gives you a very solid positive feeling first time that it's right. So onwards and upwards. Next task, when all corrections have been made, and is that the same question? That's the same question, forget that. Item B, certain errors will be disclosed by the trial balance. So recording a payment of rent as a debit in the rent expense account and a debit in the cash account will or will not be disclosed. Well, so we've got rent, we've got cash. Let's say it's £100. Does that look like an imbalance to you? It certainly does to me. So that certainly will be disclosed by the trial balance. Okay. Recording a payment of rent as a credit to the rent expense account. We could use the same one again, but we won't. So if we've paid it, the money has to have come from somewhere. Let's say the money has come out of the bank. Money out of the bank, oh, let's say it's 150 this time, is a credit because we are reducing the asset of bank. We've posted a credit to rent expense. Is this another imbalance? It certainly is. Recording a payment of rent as debit to the telephone expense account and a credit to the cash account. Do you notice how I always like to put the ledger accounts one above the other? Because you can see at a glance, whoa, it's all on the left, there's more on the right. If you put them all over the page, it's a lot less instant. So we've got rent, telephone expense, and cash. Oh, let's say it's £50 this time. So we've debited telephone expense, credited cash. Well, is there an imbalance? No. So that is not going to be disclosed. What do we need to do to fix it? Well, we obviously need to do that. What do we need to do to fix these? Just taking it a step further, because that's obviously going to give rise to a suspense account. So I should have used a different color. So that's got to come out of cash instead. There we go. That's nice and neatly done. And then this one, we must have had 300 there. So this time, again, money should have come out of the bank. So once again, no, it's not. What am I saying? Rent expense should be a debit. There we go. All nice and neat. debits and credits all lined up, all in balance, gives you that comfort that you can crack on to the next one. We don't need to spend hours checking. A further error has been identified as follows. A bank payment for a new motor car, not much of one these days, sadly, has been treated as motor expenses. So, first of all, record the entries needed to remove the incorrect entry and to record the correct entry. Okay, well, once again, let's lay them out like this. So, you can just pick out the words. We can see bank, we can see car, and we can see motor expenses. Bank, car, motor exp. 10,000 has come out of the bank, has gone to motor expenses. That's where we are now. Where should we be? Well, it should have gone to the car. So we need to charge 10,000 cost of car, take it out of motor expenses, and there is our answer. Notice in this case we are asked for the entirety of the journal to remove the whole of the incorrect entry. So what we're actually going to do in this case, therefore, is we're going to put the money back in the bank. And this is good practice because it does mean that everything is nicely in a pair. So we're going to take it out of motor expenses. And then we are going to charge it as a car. And this is what we call an error of principle. And principle because we've used the wrong class of account. Worth exploring perhaps why this matters. Remember we talked about in the statement of profit or loss, we said that the credits outweigh the debits, and that's our profit, we said. And on the statement of financial position, we said the assets compared to the liabilities tells us our capital. If we record an asset, not as an asset but as an expense, the effect that that will have will be to increase our expenses, and can you see what that's done to our reported profit? And it will reduce our assets similarly, and as you can see, the profit that would be added to the capital is substantially reduced. So the reason an error of principle is very important is that it does impact on both the profit we report and the value of the business, given that the value of the business is the difference between the total of the debits and the total of the credits, total of the assets, total of the liabilities. That is the value of the business. So an error of principle is much worse than an error of commission, where we simply perhaps put rent expense as motor expense, because they're just different expenses within the same group. Finally, what the task might look like. What we have to do is extend this trial balance, and very kindly, the adjustment fairies have done all of the adjustments for us. So all we need to do is produce the special tool. And here's my special tool. It's actually my office thermometer, which no wonder I'm shivering. 16 degrees, it's a bit cool up here. What I do is put it on one line at a time. What's a shame is that you can't actually see that, but I'm just using that to mask off all but accruals, so that I can identify that there is just one figure to sum. There's actually a preliminary step we should explore first, though, and that is, I like to label each line with where it's going to go, because there's a danger that if you just start working them out, you forget which ones are which. So let's color code these items. Each of these items is going to go either to statement of profit and loss or the statement of financial position. So let's use yellow for profit and loss and a rather fetching shade of blue for statement of financial position. So accruals is a liability. Admin expenses are obviously profit and loss. Bank is hopefully an asset, but not always, but it's certainly going to go same place. Now we'll leave this one because this one's a bit tricky. Depreciation charge is an expense. Equipment at cost is an asset. Accumulated depreciation relates to that asset. Opening inventory has been used up. We haven't got it anymore. It's no longer an asset. It was an asset a year ago. Wages and salaries, expense. Prepayment is an asset. Purchases, that's a thing that happens. Payables ledger control, ouch, that's a liability. Sales, that's something that happens, brings money in. Receivables control. Rent's just an expense, and drawings, like we said, is the one that spoils everything. VAT, it's very popular to see VAT as an expense because it's something we end up paying for, but it's not. VAT is either a reclaimable asset if we are perhaps a seller of food or books or children's clothing. Reclaimable asset because we actually don't collect any VAT on sales of those, but we still pay VAT for our materials. Or it's a liability and therefore statement of financial position. Very popular error to call VAT an expense. So accruals, going to go over to statement of financial position, and we can see that the balance is on the credit side. Admin expenses, statement of profit or loss. And again, they're both debits, so we simply combine 33,550. Bank, we started with 4,500 in the bank. There is a minus 6.5 adjustment. So bank, sure enough, the overall balance there is a credit. We're overdrawn. Now, closing inventory, I said, was a bit special. I suppose what we can say is it is both an asset because at the end of the year, you've got a warehouse full of stuff. It is an asset. So that's going to go statement of financial position, but it also is involved in the statement of profit or loss because the logic of the inventory we have used up in the year, what we say is we've used up everything we had at the start. So we're charging the opening inventory as a cost. We've used up everything we've bought. So we're charging purchases as a cost. But then we are adjusting the amount we have used up by what's left over at the end. So we put into the statement of profit and loss the opening inventory, we put in the purchases, but we take back the closing inventory. Hence that goes in two places. So the easy one to remember, at the end of the year, you've got a warehouse full of inventory. That's an asset and quite a sizable one too. So the asset is what goes on your statement of financial position, and therefore that is where your debit goes. For every debit, there has to be a credit. So that's all that is left for us to put on the statement of financial profit or loss. So do the easy one first. picture it, a warehouse full of stuff. Of course it's an asset. Of course it's a debit on the statement of financial position. The depreciation charge, our expense, statement of profit or loss. Computer equipment at cost is an asset. My pen seems reluctant to write. Has anybody got any electronic ink? I think I'm running out. Accumulated depreciation. Now here we've got an adjustment. Oh, not doing that one in my head. Too late for that. 30880. Opening inventory, we've said, is used up as statement of profit loss. Wages and somebody's done the wages and salaries for us. How kind. As you can see, it's the net figure. We've got a debit and a credit, therefore let's net it off. That's done. These are all done for us, or are they? Yep. Drawings. The one that doesn't fit spoils all my lovely neat ways of describing it. 10250. It's an adjustment to capital, and so it goes to the statement of financial position. And then our VAT, also statement of financial position. So this must be, doesn't say what they are. They must sell books or food. So I'm going to cheat at this point and not add all those up. Somebody's added them up for me. Except that what we can say is total of those debits there, I shall make a little note in rough here, comes to 162380. The total of those credits there comes to 171640. The total of the debits here comes to 99170. And the total of the debit, the credits here comes to 89910. So the difference between statement of profit and loss columns is 9260. And we're going to use the same total for both. So our balancing figure to make that balance has got to go in on the debit side in the statement of profit or loss, 9260. And that's good. That means the credits outweigh the debits by 9,260. So we must have made some money. And sure enough, exactly the same difference applies to the statement of financial position columns. So again, the higher total is the one that goes in. The balancing figure needed again is 9260. So our credits bringing the money in have outweighed our debits taking the money out by 9260. As a result of that, our assets have grown by 9260 relative to our liabilities. So we're £9,260 better off. And that is what you do. Well, thank you for coming tonight. That's the end of the session. I'm going to stop the recording.